All right, I think we've got enough people rolling in here now, so we'll go ahead and get started. All right, everyone, thanks for joining us today. My name is August Schwartz. I'm the art director of What's Up Media. Today we're joined by Randy Fisher. Randy Fisher is a member of Frost Law, a wealth counsel, a national network of more than 1,800 estate and financial planning practitioners who collaborate on best practices and changes in the law. Mr. Fisher began practicing law in Washington, D.C. in 1988 and opened his Annapolis practice in 2004. In 2019, Mr. Fisher was again honored with an AV rating, the highest possible rating for legal ability and ethical standards for 23 consecutive years by Martindale-Hubbell, the legal profession's leading peer review organization. He has also been given the Client Distinction Award, among other awards and honors. You can reach Randy and his team at askfrost.com. Today, we're also joined by Tim Stoltz at Bestgate Wealth. Tim is a certified public accountant and certified financial planner with over 10 years of financial services and tax experience. He earned a Bachelor's of Science in Accounting from Towson University, as well as a Master's of Science in Taxation from American University. Tim brings a well-rounded and extensive background of financial and tax planning for businesses, as well as individuals, trusts, nonprofits, and estates. You can find more on Tim and his team at bestgatewealth.com. All right, guys, take it away.
Well, we want to start talking some basics of estate planning. And then from the basics, we're going to roll into some financial aspects, which is where I'll turn it over to Tim from that standpoint. So when we have next slide. The thing about estate planning, it's this is going to give you a reason why it's important and how it's important to the financial future of your family. Next slide. So you start, all plans start with a will. You'll have incapacity planning behind that. You'll have some goals and objectives that you want to work off of both of those. The basics of a will, you also want to have durable power of attorney for financial affairs. You want to have a healthcare power. You want to have a living will so that you're not in a situation where medical professionals are required to keep you alive beyond a point you want to be. Next slide. On the financial power of attorney, that's where you nominate an individual who can make financial decisions for you. If you're incapacitated or otherwise unable. You may be out of town, you may have had a car wreck, you may be unconscious. As part of that same document, you can create one that nominates a guardian for you in case you will need one. On the healthcare directives, you start with living wills. That's where you prevent unwanted artificial life sustaining treatment. The basics there, doctors are required to keep you alive unless you present something that says that you don't want to be kept alive. In a healthcare power of attorney, it goes to the individual who can make decisions for you in the event you're unable. They don't make them instead of you, they just make them when you can. It also would nominate a guardian if needed. We'll go to the next slide. Next, yeah, there we go. Estate planning is a process where you arrange the transfer of assets in anticipation of your death. You can either have a plan or the state of Maryland in its infinite wisdom will create one for you. The question about simply doing nothing and letting the state of Maryland plan for you, is it one you'd want? So let's go to the next slide, we'll take a look. In the state of Maryland's plan, if you have a spouse and children, at least one of which is a minor, then the spouse legally receives 1/2 and the children divide what is left of your estate equally. If you happen to have a spouse and at least one and an adult child, the spouse starts with the first 40,000 and then 1/2 of the estate, and the children divide the estate that's left equally. If it's children only, the children would divide the estate equally. If it's a spouse and a parent, the spouse again starts with 40,000, and then in what's left, it's divided between the parents and the spouse. If the marriage is greater than 5 years, well, then the parents don't inherit. That's what a Maryland plan, if you die without a will, requires. Next slide. The will is a substitute for the state's plan. It's a document that controls the flow of your assets. It's in things that are in your name only. If you have a car and it's only got your name on the title, then it has to go through probate. And the will directs where that car would go. If you have a house that's only in your name, same thing. A will does not control things that pass by a beneficiary designation. Things that, like life insurance, IRAs, transfer on death agreements by contract, things like a joint tenancy with right of survivorship or a trust. When Tim talks a little bit, he'll walk you through some of the beneficiary forms and things that financial planner would walk you through. The biggest thing about a will is you need to know where it is. A will that's lost is a will that doesn't exist. Next slide. If you probably already have documents that control some distribution. The beneficiary designations on your retirement accounts, life insurance. You may want to add a trusted family member to your bank account or designate your accounts as transfer on death. Those items would then avoid probate. They would slide to those members. You also want to check your deed. If you bought a house, then you got married, you may not have gone back to add your spouse to the deed. These are things you can check at a website called the marylandlanddirect.net. Very easy to use, very easy to sign up for. You basically research it by your street address. Next slide. Probate is the legal process that takes place after someone dies. It's the identifying of the property, having the property paid, paying debts and taxes, distributing the remaining property as a will, or by state law if there isn't one. It's only assets that are exclusively owned by the deceased person passing without a beneficiary designation. That's that form you fill out when you open a joint bank account. When you open a savings account, they will invariably ask you who you want it to go to, and they'll slide one of those documents in front of you. Or things that are owned jointly without survivorship rights that have to pass through probate. Process is overseen by the county's Register of Wills. Next slide. Last item is a trust. Go ahead, next slide. Trust is a vehicle that holds assets. It is a fiduciary arrangement that allows a trustee to hold assets on behalf of a beneficiary or beneficiaries. There are many types of trusts that work, and they depend on the individual circumstance. You can be trustee of your own trust and be the beneficiary of it. It gives you greater control of your wealth, your privacy, saves money and time on probate, and offers some more sophisticated planning for incapacity. The con, it costs more to set up, and the trust may require ongoing administration. That's going to depend on the facts and circumstance of what you're putting together. Go on to the next slide. A revocable trust is something that can be changed. You can come in one day, you can come in 3 days later and change who it goes to and change all of the facts and circumstance of that trust. If you retitle assets to the trust, or if you aim beneficiary forms to the trust, it doesn't go through probate. It does offer enhanced incapacity planning over a will and avoids unwanted publicity. It's useful also when an individual has real estate in different states. If everything's titled to the trust on real estate in individual states, you simply change trustees. The best advantage of a trust is the beneficiary dies, not the trust. And if you change trustees, that's not a death, that's not a probated fact. There's no tax consequences or benefits from using one. Go on to the next slide. A spendthrift trust is a legal mechanism for protecting assets for a beneficiary. That's in the case you have a younger child, maybe greater than 21, but less than maturity, where they would love nothing more than to tell Tim to pull out all the money out of the funds because they've got their eyes on a red Corvette. Or in the case of my daughter, every pair of red shoes up and down the Central Maryland coastline. When a beneficiary has limited rights to seize assets of a trust, the creditors can't come get it. A good estate planning tool, it's a very good estate planning tool if a child has addiction issues, has current or foreseeable creditors, or there's a concern about divorce. In Maryland, you can't set one up that benefits yourself, but you can set it up in other states. Delaware, Alaska, Wyoming, Nevada are 4 favorites. Next slide. For minor or a disabled person who cannot legally care for themselves or their inheritance, you can use a guardian. It's a person that'll have legal custody of a minor or a disabled person. Guardian of the property has the right to manage the property for a minor. Both are subject to court oversight and terminate when the minor comes of age. This is also true for your own children. You can, if you're taking care of your children and then they become of age, you have to go to court to get renominated as a guardian on their behalf. There is a form of account called the Uniform Transfer to Minors Act, which allows you to transfer funds to a custodian until the minor reaches age 21, and there's no court oversight. The key element to it is at 21, they get all the money. So they need to be mature enough to handle whatever you've left them. Third is a trust. By transferring it to a trustee, you can customize the document for the minor's benefit. You can customize how or when they get it and what it can be used for. Go on to the next slide. Finally, there's the death taxes. Right now, federal estate tax is 40% of everything greater than 11.58 million apiece, so that a husband and wife can protect more than $23 million. This is something that I'll leave a little bit to Tim to talk about in terms of higher end clients, but it is something that there are planning mechanisms that can occur and can be quite useful if you're fortunate enough to have worked hard enough to get over that $23 million figure. The Maryland estate tax is somewhere between 8 and 16%, and it's imposed on someone who dies when their assets exceed $5 million. Now, there are two types of taxes in Maryland. There's the estate tax and there is the inheritance tax. The estate tax is one that goes to everyone who has greater than those amounts. The inheritance tax comes into play depending on who you leave your bequest to. It's Maryland inheritance tax is either 10 or 11%, depending on who pays it, and it's imposed on transfers to non-exempt individuals. I leave money to my wife, to my children, to my parents, to my sister, to my grandchildren. There's no tax. I leave it to cousins, nieces, nephews. That's when it comes into play. Depending on the type of asset, there is typically no income tax on an inheritance. However, there are income taxes that come into play, and I'll leave a little bit of this for Tim on retirement vehicles, because no tax has ever been paid on that money. So good planning needs to occur when you're distributing retirement type assets. Next slide. Final thought is it's important to figure this out. It's important to figure it out in advance. And it's more than just a will or a trust and some of the documents. You've got passwords, you've got codes, you've got security questions that somebody may need to get access to take care of things you want them to take care of. I can speak from personal experience on that. I had the unfortunate thing of recently losing both my wife and my son, and I've gone through hell trying to figure out who my wife's favorite fourth grade teacher was, equally to try to get open a phone, the code on the phone. I can't encourage you enough to share the 6-digit, 4-digit, how many ever digits it is that protects the cell phone. Everything rolls in our lives now through those digital vehicles. All of that is part of a plan. Whether you come work with us or you come work with somebody else, I just want to encourage you that. Go ahead and roll it to the next slide. None of this is specific legal advice, and it's only for information. If you want to come see us, we'll establish an attorney-client relationship, and then we can give you some advice you can rely upon a little greater. With that, I'm going to turn it on over to the true expert. That's my partner in crime, Tim. Tim, why don't you take it from there?
Sounds good. Thanks for that, Randy. So now that Randy's given us a great baseline by going through the nuts and bolts of estate planning, I'm going to take some time to discuss some planning ideas from the financial perspective that may be appropriate based on the overarching environment that you find ourselves in. My first several slides will be focused on planning for very wealthy families, and then I'll wrap up with some planning ideas for the rest of us. This is obviously what I do and my firm does, Bestgate Wealth Advisors, Bestgate Tax and Accounting Advisors. We really try to work with the attorneys to create a good comprehensive plan so that we can avoid any unnecessary taxes, which are a huge aspect of any estate plan and financial plan in general. And also, find all of the most efficient ways to get these things done. Everybody's probably noticed at this point that the world's been flipped upside down due to COVID. We already had some of the pressures on the system that I'm going to discuss, but over the last 3 months, everything has been exacerbated to an exponential extent. Our current income tax rates are at historical lows, especially for business owners, and the national debt was already growing in a way that, created a lot of concern among professionals out there. Now, with all of these COVID relief programs, national debt is growing by, multiple trillions of dollars at once, as opposed to, merely a few $100 billion a year or only $1 trillion a year. So, you can expect that in general, taxes will be going up, and particularly taxes on wealthy individuals are likely to go up in the future. Randy mentioned the estate exemption amounts, which also are on my next slide. These exemption amounts are set to sunset after 2025. So, right now there's a huge exemption that allows you to transfer a lot of wealth at one time, estate tax free. If nothing is done by 2026, these will be significantly reduced. Another general comment related to the current economic environment is for closely held businesses, which are a lot of clients that we work with who have significant wealth. 2020 may be a little bit of an aberration where it's a bad year. Perhaps there's a loss or, significantly less income than normal. That may actually provide some opportunities to do some estate planning where you can transfer wealth while closely held business valuations are lower than they may otherwise have been over the last 2 to 3 years. So, it's a perfect storm that creates a lot of pressure to talk to people like Randy, if you have not already, about addressing some of these issues. Next slide, please. So as Randy mentioned, the current exemption for any individual's estate is $11.58 million. Each spouse gets the same amount of an exemption, and there's currently something called portability that allows a surviving spouse to use their previously deceased spouse's exemption. So for a married couple, they can essentially transfer about $23 million of wealth right now without being subject to estate tax. And a lot of families who are wealthy but not in the stratosphere of $20+ million have felt very comfortable over the past several years with the current exemptions. And because the estate tax does not generate a lot of money for the government, there's generally a feeling that there's not a lot of pressure to bring these exemptions down, because it's a big fight with wealthy donors that really doesn't generate that much tax revenue. Now, on the flip side, it is a symbolic tax that politicians who represent more ordinary Americans might want to lower the thresholds, more so to show their constituents that they're concerned about ordinary Americans and not wealthy Americans, more so than actually fixing any issues that may exist in our revenues for the government. After 2025, the estate tax exemption is set to go back down to $5 million. Now that's plus inflation, which would, in 2026, probably be a little over $6 million or so. So, there still is in the current code the ability to shelter probably $12 million of wealth or so after 2025. The real wild card that we don't know is what happens if we get some change in our government. Currently, the Democrats' platform would call for the reduction of the estate tax exemption. Bernie's exemption number was very low. Not sure exactly what Biden's was, but he's changing his tune on a lot of things right now. So, you know, once we get to the Democratic convention and see what the final platform is, we'll have some expectation about the extent to which we may have a change in the future. Randy, do you have a comment?
No, the only thing I would add to that, Tim, was that President Obama's last number, which he knew he couldn't get because he didn't control Congress, was 3.5 million.
Mm-hmm.
So I don't know if that's still the right number or not, but.
Yeah, and I agree with you. I think that would be sort of a reasonable expectation for Biden 3 months ago. Now that everything that's gone on in the world has happened, I don't know what to expect, you know, since Biden seems to be moving more towards the left in general. And, you know, there are more significant debt issues, you know, so it remains to be seen, but, you know, most definitely the expectation is it's going down in the future. And the question is to what extent? And
yes.
So, you know, based on all of that information, the conclusion that we draw here is that families of significant wealth should seriously consider making gifts now that are treated as completed gifts for estate tax purposes so that they can get that wealth to the next generation using these current exemptions. That's something that some people may not realize. While the exemptions are at these current levels, the gift tax exemption is currently married up with the estate tax exemption. And if you make lifetime gifts, you use up this estate tax exemption. And if you were to make gifts in 2020 of $11 million, you would use up your estate tax exemption. And then in the future, if the exemptions are reduced, you still have that money out of your estate tax-free. So, you know, there is potentially some time pressure to get some of these things done if you think these taxes may affect you. And we'll come back to some of these discussions in my future slides and, you know, probably discuss it a little bit more and can go over some questions if need be. Next slide, please, August. So another factor that's out there related to making gifts and some current pressure to get things done relates to valuation discounts. Valuation discounts are a really important planning aspect for estate planning and gift planning, which are available right now. The way that it works is if you have a closely held business and you want to make a gift, or if you have passed away and it's going through your estate, you typically need to hire a valuation firm to prepare a valuation report on the business entity that's being transferred. And closely held businesses, based on current law and rules, allow for discounts based on the lack of marketability of the business and a lack of control of the business. So for instance, if I have a construction company and I have a 10% minority owner of that construction company, they don't have the ability to go to the general market and sell their 10% ownership in this construction company like they would if they owned stock of a public company. So therefore, that ownership is not as valuable as it otherwise may be because they can't just go sell it. Similarly, that 10% interest would not have control over managerial decisions of the company, including decisions like distributions to make to owners, and therefore that reduces the value of the business. So we've seen in practice very regularly discounts that can range from 20% up to 50% of the value of the business, you know, based on what kind of restrictions there are on management and, you know, a lot of other factors. There's also recently been a court case that provides what we call the Wandry language, because that's the name of the court case, that allows you to make a gift in a specified dollar amount rather than a number of shares which is an estate planning tool when you're making these valuation decisions and gifts. And having the report done is crucial to uphold a value and a discount if you have IRS scrutiny. If you list that 10% ownership of a construction company as being worth $1 million on your estate tax return, and the IRS audits you, if you don't have a valuation report done by a certified valuation analyst that was done contemporaneously with the death, then the IRS is going to have a really wide ability to adjust the value based on their analysis. If you have a report that was prepared professionally at the time that you completed the tax returns, you're very likely to have very good defense against any valuation adjustments. And here's the big thing that's going on with timing. There are proposed regulations that would severely limit the usefulness of valuation discounts. These regulations were proposed in 2016 and have been shelved during the Trump administration. This is another thing that could be in danger for estate planners if we have a Democratic White House and Congress where valuation discounts may be reduced, what's possible to get. So, a combination of potentially lower valuations because of economics and the fact that discounts are available and large estate exemptions create, a good opportunity for gifting to be done. Next slide, please. So, as we mentioned, families with more than $23 million of assets clearly have a huge difference in estate tax if they make gifts prior to the exclusion being reduced and losing some of these valuation tools. One middle ground is families that make gifts of more than $5 million may want to give that gift from one of the two spouses. And so I have an example here where a wife gives a $10 million gift to a trust that for state tax purposes is considered a completed gift. It's less than her current $11 million exemption, so it does not generate any estate tax. The husband maintains his exemption. So let's assume he lives to 2030 and the exemption goes back to $5 million. That $5 million of exemption would still be available upon his death, even though his wife gifted $10 million worth of value to the next generation. However, a lot of taxpayers, the standard operating procedure when they make a gift is to elect a gift splitting. And what that means is if I give a gift to my children on the gift tax return, my wife and I can check a box and choose to treat that gift as if she gave 50% of the gift and I gave 50% of the gift. So in this example, if this wife made a $10 million gift to the next generation, but they elected gift splitting, then her and her husband would each use $5 million of their exemption. And then if they both live past 2025 and the exemption goes back to $5 million, they now don't have any ability to pass wealth on to the next generation without incurring estate tax. So, it could potentially be a $2 million mistake to elect a gift splitting on a $10 million gift, because that's the estate tax that potentially could be due on a $5 million value later if their entire exemptions were used. Next slide, please. Additionally, something that plays into the timing of these considerations is often gifting can take more than 1 year. And a lot of this can have to do with discounts. So when you are passing control of a company on from one generation to the next, if I make a gift of 100% of the voting stock of my construction company to my son, then that gift does not get a discount for lack of control because I've given all of the control at one time. However, if I split that gift up over 3 years and give 40%, then 40%, then 20%, then each time I've given a gift, I have not given up control of the company and my discount is still intact. Similarly, people will set up companies. A lot of times they're called family LLCs or family partnerships, and contribute assets into those entities so that then in the future they can gift fractional ownership of that LLC and get discounts for lack of marketability and lack of control. So, an example, I have a client who had a $25 million portfolio that has been in an LLC for 10 years, and he has gifted fractional ownership of that LLC, and he had a valuation report that showed discounts of, north of 30%. So, instead of a gift being worth $20 million, it's worth only $14 million and uses much less estate exemption. So, part of the planning process can be, we have to set up an LLC and then it needs to operate for a year or two before we even give any gifting, because we don't want we have to have a business purpose for this LLC other than gifting. So you might want to set up an entity, wait a year or two, then start giving gifts that may take 1 to 5 years to give. So just because the exemption doesn't sunset until 2025 doesn't mean that we shouldn't be proactive and be making plans now to pass wealth on to the next generation.
Tim, I'll jump in here and just add a layer onto what you just said, that in the gifting, a lot of my clients will think I'm saying, give your wealth to your children, which makes them panic a little bit.
Of course.
But you also can, we talked about basically self-settled trust that Maryland doesn't allow. You can gift to additional trusts that are irrevocable trust, and so you're basically spreading your own ownership out through exactly the same process. That's all I was going to add to it.
Yep, absolutely. There are definitely ways to make a gift where you're actually putting the assets into a trust, but then the grantor and or his or her spouse may have access to income or assets within that trust.
Absolutely. That was it.
Exactly. So it's not gifting like you've actually fully given it, even though it is treated as a completed gift for estate tax purposes. And the other thing on this slide that I have as a reminder with timing is that gifting also gets appreciation out of your estate. So when we're talking about closely held businesses that are in growth mode and they're growing revenue by 10 and 20% a year, they may be growing value by 10 or 20 or 50% a year. And if I make a gift now of an asset worth $5 million that grows to $50 million by the time I die, and that's through a trust, then I've given away $50 million, which would be well above the exemption. But since I've used a trust strategy to gift it early, all of that appreciation goes to the next generation, estate tax free, and does not use up my exemption. Next slide, please. And so I have a couple notes here for special trust provisions, and this is what Randy mentioned. The first provision I have here is really the name of a type of trust that people use, a spousal lifetime access trust, or a SLAT. These can be used to make a gift, which the donors would still have some access to. There's something called the HIMSS, which is health, education, maintenance, and support. That is a basic level of access that the grantor and or the grantor spouse may have to the assets or income of the trust, even though they've gifted it. And there actually are other ways to get even more access that you could work with somebody like Randy on setting up a trust with provisions that work for you, so that you still have enough income and assets to live out your life. Another thing is a grantor's right to substitute assets. This can be a big deal because when you make a gift from one generation to the next, your heirs get the basis. So if I have a building worth $5 million and it's fully depreciated and I give that through a gift to the next generation, if they no longer have any depreciation on that building, or if they sell it, they have gain on the entire thing. But if it goes through my estate, then my heirs get a step up in basis and they can restart depreciation or they can sell it at no gain. So if you funded a trust and put assets in and they have low basis, or they end up having low basis over a period of years, if you have the right to substitute assets, you can take, you know, stock that you've recently purchased where your basis is equal to the value, substitute it for that asset that had low basis, and that is, you know, an after the fact planning tool. I'm going to try to speed up here because I know we want to save a few minutes for questions. The one last item on this slide is just giving the grantor the right to pay taxes, and the grantor is the person who made the gift to the trust. So this is something that can supercharge estate planning because if I use my $23 million family exemption to fund a trust for the next generation, but I still have $50 million of value in my estate that would eventually be taxable, what can happen is we can put assets that generate a lot of taxable income in the trust, but then I can use my personal money to pay the taxes, which reduces the value of my estate and increases the value of the trust. Next slide, please. So now I'm finally back to the planning for the rest of us. So one thing that people like to do when they give gifts, they want to give a gift that does not require them to file an estate tax return or a gift tax return because it's an administrative hassle. Also, if you are expecting to have a taxable estate, you can use these annual exclusion gifts and they do not count towards your exemption. So for 2020, you're allowed to give $15,000 to any individual with no gift tax consequences. Gift splitting would allow that to be $30,000 for any married couple. In order to do gift splitting, you have to file your gift tax return. Instead, you and your spouse could each write a separate check if you're just giving money. This then can be doubled again if you give a gift to a child or a grandchild and their spouse. So you can essentially give $60,000 to any married person who you want to make a gift to each year. And for people who have multiple children and grandchildren, you can move a good bit of wealth this way. Next slide, please. One area that I like to focus on with clients is doing good IRA planning when we're talking about their estate plan. This is especially more important now with the Secure Act that was recently passed, because inherited IRAs are now required to be withdrawn within 10 years of inheritance. And that's a big deal because when you inherit an IRA, when you make a withdrawal, you have to pay income taxes on that money. So if you have to pull all of the money out quickly, you may be subject to a lot of tax on that, especially if it's all in 1 year. And this may require old trusts to be amended. A lot of IRAs are directed towards trusts. And the way some of them are written might require that distributions only come out as the required minimum amount for the first 9 years. And then the 10th year, the required minimum distribution would be the rest of the assets. So if you pass an IRA to me and it goes through a trust and I'm only allowed to take the minimum for 9 years, and then in year 10, I have to take all the rest of the money. So if that was $1 million, I might only take out a few $1,000s each of the first 9 years and then have $1 million of income in year 10, which would subject me to higher tax rates than if I did it evenly over those 10 years. So that flows into the idea of doing Roth conversions. It makes Roth conversions even more attractive at this point. Going back to the overarching environment, income tax rates are historically low right now, and our debt is historically high and growing at a pace that it never has before. So you can expect in the future there may be higher income tax rates. Roth IRAs are different than regular IRA because you pay tax now, and then in the future, you never pay any income tax on that. So in our current environment, Roths are very attractive, especially if you have more of an elderly person without lots of earned income. They could potentially be at very low tax rates. And, this is really for ordinary individuals rather than wealthy. If you have grandparents who, only have Social Security in their IRAs and they're only paying a 10% tax rate, and then that money would go to a child who's in their prime earning years and is paying high tax rates, makes a lot of sense for the elderly individual to pay the tax at current rates. And then in the future, there will never be any tax on this money. Additionally, if you do this conversion, you do owe tax right now, but what you can do is you can use your cash that you have outside of your IRAs in order to pay the taxes. And what you're doing is effectively contributing to your retirement accounts with cash that you have, even if you're not working, or in excess of what current retirement contribution limits are. So that can be a really effective tool for long-term planning. And that's part of what we do. We like to model out these scenarios for people. And, this can have 6- and 7-figure impacts on your ultimate assets at the end of your life. A last item on IRAs is that if you have a charitable intent in your will and you have an IRA, it's absolutely a slam dunk to use the IRA to fund that charitable intent. And the reason for that is income taxes. If you leave that IRA to your children, they have to pay tax when the money comes out. So a $100,000 IRA might be worth $60,000 to them, but to a charity, a $100,000 IRA is worth $100,000. So if you want to give $100,000 to a charity, and you use cash through your will while giving an IRA to your kids, you have unnecessarily lost $40,000 of wealth transfer. Next slide, please. So continuing with the charitable theme and IRAs, there's something called a qualified charitable distribution from an IRA. And you can make up to a $100,000 gift once you've reached 70 and a half directly from your IRA. And that satisfies the required minimum distribution, which ordinarily is taxable. But in this case, it's not included in income. And that can have a lot of impacts, especially when you start looking at things that require, you phase out of certain benefits if your AGI reaches a certain level. This allows you to take your RMDs out without it ever showing up as income. One other strategy with gifts is giving appreciated stock. You get a deduction for the entire value of the stock as opposed to your basis, and you never have to recognize the gain. So never sell stock and make cash contributions to a charity. If you have appreciated stock and you're giving cash to a charity and it's more than $5,000, then you're making an estate planning mistake. The last item on this is donor advised funds, which are really more beneficial now with the new income tax laws with the higher standard deduction, because some individuals are very close to having enough itemized deductions to itemize, but they're not itemizing, but they might be giving $5,000 or $10,000 a year away to charity. So one way that you get your deduction for this is make a large gift in 1 year to a donor advised fund, and then and then use those funds over the course of 10 years to make the donations that you normally would. And this moves all of the deduction into 1 year and also allows you to get some appreciation with the assets that you've contributed. You can kind of contribute the appreciated stock to these donor advised funds. Next slide, please. So that's it. There's a lot more information. We could talk for hours on these topics. And, this is the kind of stuff that we really like to do with clients to help them, really maximize their wealth for themselves and for their children and their grandchildren. So we appreciate your time. And if any of these ideas struck a nerve with you, we'd be glad to talk with you about, doing some planning in the future.
All right, yeah, looks like we have a couple of questions. First question, hi, question regarding section 2036 of the IRS code. I attended a tax class online in which the estate planner cited section 2036 as an incomplete gift. If the grantor receives income from the gift, then it is an incomplete gift and the heirs can get stepped up basis upon the grantor's death. Wondering if I understood this correctly and what is the amount of income considered to meet this definition?
Okay, so Internal Revenue Code 2036 deals with transfers with a retained life estate. And, this is all very facts and circumstances based. So it's hard to give an answer for, the person's question without having all of the facts. But in general, you can give a gift that's incomplete, and therefore it's not, for estate tax purposes, you haven't given the gift. And if that's the case, then you get the stepped up in basis at the grantor's death. So, depending on the facts that you have, you probably are thinking about this correct. I know, if we're talking about a home with a retained life interest, there are a couple different types of deeds, and I think that may vary from state to state that could give you different answers. So, it's definitely something to consult with a professional about to make sure that you do it correctly. I don't know if you have any additional thoughts on that, Randy.
No, I think you've covered it very nicely.
Okay, thank you.
Okay, a couple people are asking about the slides. Yes, the slides will be available in addition to the recording itself, and they'll be sent out shortly after the presentation ends. We have another one here. My ex-wife's family just sold a property that I was a part of the LLC. $100,000 will be coming from the sale. I want to give it to my children and to my ex. Does the money need to be transferred directly to my account, or can it go directly to an account in her name? Ultimately, it will all transfer to her and my 2 kids. I'm trying to transfer it in a way that won't trigger any taxes.
Okay, so, when we talk about gift and estate tax, you should keep in mind that gift taxes are not typically paid currently. So if you give a gift that's quote unquote taxable, that means that it's subject to gift tax, but you have this exclusion. So if you have a $100,000 asset that you want to give to an ex-wife or to your children, you can make that gift, and presuming you haven't already used up all of your gift and estate tax exclusion, there is no tax to pay. The only thing that you have to do is you're required to file a gift tax return that tells the government, I have made a gift of $100,000 and therefore used $100,000 of my exemption. So if you're nowhere near, the $7 to $10 million value of an estate that we expect to be taxable in the future, then giving a gift of $100,000 generally isn't a big deal, and you should just file the gift tax return. And there are a lot of different ways that this could be transferred. And like with everything here, the facts really matter. If you are in a future taxable estate situation, and that's why you're not worried about the $100,000, you may want to do some planning ahead of time to make this gift before the property is sold, because you might be able to get discounts on lack of marketability and lack of control and some of those kinds of things, and potentially use some amount less than $100,000 of your exemption.
Okay, what total amount of assets does it make sense to have a trust?
Well, it depends on the facts. Again, not all trusts are estate tax driven. Often it's behavior driven. And Randy probably could speak to that with a lot of examples, even more so than I can. But, he mentioned Spendthrift Trust. If you have $400,000 estate and you don't want your single child to get all of the money because of, negative behaviors they have, you might want to put that money into a trust, even though it may not be the most cost-effective thing to do. There's also trusts that are used just to avoid probate, so that you don't have to deal with the court system in transferring your assets. And that's more about privacy and a lack of dealing with the courts, as opposed to estate tax planning driven. So, it really depends in a big way. But, you know, if you have a decent amount of assets, you should absolutely be working with a financial professional to make sure that you have the appropriate estate plan in place, whether it's to avoid taxes or just to make sure your wishes are carried out.
Okay, I don't see any more questions. If anyone else has any questions, let's see. One last detail, can I have the funds from the sale go directly to her account, or would it need to go to my account first, then transfer to account? This is in reference to the family selling a property question.
Yeah, I mean, I would say if you're going to file the gift tax return, there's probably no harm in it going directly to the ex-spouse's account. You won't necessarily have a trail of it, but you're still reporting that it occurred. I don't know if you have any other thoughts on that, Randy.
You're either gifting ownership or you're gifting the cash, but you're creating a trail. So if he's gifted ownership prior to funding, then the money could go straight to her account. But your key element is that gift tax return.
Okay, I think that about wraps it up. Thank you guys. You guys can get in touch with Randy at askfrost.com or info@frosttaxlaw.com. You guys can get in touch with Tim at bestgatewealth.com or at info@bestgatewealth.com. Appreciate you guys coming on.
Thank you very much for having us.
Absolutely.
Take care.